Good morning, traders and investors. Today is D-Day, decision day. From the Fed at 2 p.m., we'll know if they go 50 basis points or 25, or the off chance they go 0 or 75, but it's looking like it's going to be 50. But Powell's going to be deciding more than just the interest rates because I'm due for a haircut, and I've decided based on their decision of rate cuts is how I'm going to get my haircut next time. If they go 50, I'll get more cut off. If they go 25, I'll get less cut off. So I've got my own personal, reasons to be worried about this rate cut. My haircut is at the helm of Mr. Powell as well as our economy. We've got a lot. I wouldn't say we've got a lot to talk about today, but we got a decent amount of things to talk about today on this big Fed preview day. So let's go ahead and get pre-market prep started. Welcome to Benzinga's pre-market prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
All right, let's pull up my trusty Benzinga Pro, run through the indices real quick before we get started. You've got the S&P 500 trading slightly in the green today. You've got the Qs also in the green, again, in anticipation of these Fed rate cuts coming today at 2 p.m. Got the Dow. Everything's in the green. Let's go over to Bitcoin. We know that Bitcoin likes interest rates being lower than they are right now. Bitcoin coming back up to around 60,000. So you saw Bitcoin dip below 60,000 for a little bit. Really good. I mean, almost got down all the way to 50, but has since bounced back up here to 60. So all in all, let's go over to the TLT, see what's that doing. Slightly down here this morning. Let's go ahead and bring in Dennis this morning. Dennis, how are you doing? Happy Wednesday. Happy Fed decision day.
Tired. One of those days where I'm just tired. Trying to wake up, but one of those days, AB. How are you doing?
I'm good, man. We were talking in the pre-market show. Had a near missed call on a parlay last night. 13 out of the 14 legs hit. The only one that didn't was Blue Jays money line, and they scored like 8 runs. If you score 9 runs in a baseball game, you should win that game. So I'm throwing that on the pitch. It's like, Dennis, I know you're a hockey guy. It's like if the Oilers score 5 goals in a game and you end up losing. And it's like, what was going? Which, if any NHL team does that, it is the Oilers where they score.
So you got 13 out of 14. Holy! How do you get that many right all the time? Are they just like slam dunks? Like you're just playing all?
No.
It seems crazy to get 13 out of 14. So when you get 13 out of 14, though,
you get nothing.
On these parlays, you still get nothing.
Nothing. You get nada. Zero. No.
Perfect or nothing.
Trust me. There are 10-leg parlays where I'll go 2 for 8. So there are a lot of ones. But honestly, last night that was like the one bet that I placed, and I was like, I didn't even think anything of it because it was a $3 bet. And then next thing I knew, I look at my phone and it was giving me like a $450 cash out option on the $3 bet. I was like, maybe I should take this, but then I didn't. Yes. And then, whatever. It's kind of like
take part of it out.
No. Well, what you can do is what I did last time was you can take it, you can take the money and then use some of the money to place it on I could have took some of the money out, placed it on the Blue Jays. So I could have kind of de-risked. But I was scarred from last time.
You could have totally did that.
And no, this isn't a gambling show. Dennis asked how I was, so I explained how my night was, and that was the.
We're a stock market show. It's all a little bit of gambling. We all gamble, educated gambling, but
John asked.
It applies. John's right. Why didn't you hedge? There's so many things.
Because the last leg that I needed was the Blue Jays to win, and they were losing by 2 runs in like the 8th inning. So the Rangers who they were playing were minus 2,000. So I would have had to put $2,000 on the Rangers just to win $100, and it just wasn't worth it. But it is related to trading because I was explaining to Dennis, it's like if you're in a trade and it's going really well, that's when you're the least incentivized to get out of the trade because you're like, oh, I'm in this stock and it keeps going up. I was right about this. But that's like when you want to, when your profits are the best. So like when the cash out option was the highest for me,
that's when it feels the best.
Is when it looked like the bet had the best chance of hitting. So I didn't want
Yeah.
to cash it out.
Yeah.
But all right, let's move to the stock market.
Exactly how trading is. When it's going the best, everything's just rip and roaring. You're like, why would I sell now? We're flying. It's
Right.
hard sometimes to sell at the top.
Exactly. Yes. And
Yeah,
Joel
so there's
is
lessons here, folks. If you stick around long enough and don't mute it when the gambling starts, there's lessons to be learned here.
Yeah.
Yes, Joel is okay. He will be back. He's just taking a little R&R, much needed R&R, but he will be back, and I'm sure with some stories.
All right, let's get to the stock market. I also mentioned, Dennis, in our pre-market show that you're going to be a little mad at me, and I didn't tell you why. I was going to save it for the show, but we've got the X chart pulled up, and it's related to X. What have you been asking for the past week?
I don't even know. That's
Let's
a
see
good question.
Let's see if the chat gets it. What is Joel? What is Joel?
With X? Something to do with X?
Huh?
It's to do with X?
Yeah. What has Dennis been asking for? And what has he been wishing for Christmas?
Oh my gosh. Well, interest rate cuts, but we know that's coming today.
We know that's coming. All right, I'll tell you.
I don't know. You got to be lost on this one, AB.
You've been asking for a list of when company executives are speaking at events, right?
Yeah. Did they speak yesterday?
Yeah, the CEO of X spoke in Detroit, and guess who was?
Oh my gosh, it was in Detroit too, and we didn't know this.
And guess who was there covering it in person?
You.
Yes.
And you didn't tell me this.
I completely forgot.
That's ridiculous. We've been asking for this. It'd be nice to know that the U.S. Steel CEO is going to speak in your backyard. And now we see the stock pop up 3.78% because we know what he spoke about. What did he say? You should have been texting me. Denny, it's public information now. He just said this. Well, obviously the algos are all over it by then, though.
So I went into it. So and again, I forgot about it until after the show. Dustin, our head editor, was like, "Hey, just checking in. So are you still all good to go cover the ex-CEO speech?" And I was like, "Oh shoot, yeah, I got to go do that today." So I went, and in my head, I was thinking "Oh, this might not be that interesting. I assume he's not going to talk too much about the acquisition because it's going through this court and review process. And a lot of times when this stuff is going on, the executives remain hush about these topics." It was the exact opposite. He talked solely about the acquisition for 45 minutes. And basically my takeaways were, and so he basically the whole time talked about how great of a deal it was, how everyone will be better off from the acquisition. And obviously he has some personal incentive. The deal gets done at $55 a share, or whatever it is. And it's at 38, or it was at 35 at the time. He's going to be making a lot of money on it. So part of me is okay, well, he's just, talking this up right now. But the way he explained it, I came out of it way more bullish on this deal going through than I was, going into it. And I remember I was even looking at the stock while he was talking and was maybe I should buy this because I think the deal is ultimately going to go through. And basically if the name of the company wasn't U.S. Steel, and he didn't say this, but I was thinking it. If the name of the company was, Turnpike Steel Melters or whatever, no one would care about this acquisition.
Yes.
It's an $8 billion company.
Yep.
It's not that big of a company.
Yep.
The fact that it's called U.S. Steel, the optics of it, from a political, because and not to get political, everyone opposes it. Biden opposes it. Harris opposes it. Trump opposes it. So if Trump opposes it, Biden doesn't want to be the one that lets it happen so that Trump can come out and say, see, Biden let U.S. Steel become a Japanese company. I would never let that happen. So now they're pushing it off until after the election. But through this process, I think the, antitrust, the people investigating it and stuff will realize there's really no reason not to let this deal go through. Again, other than just the name of the fact that the name of the company is U.S. Steel. So these headlines in Pro were coming from during the speech.
From you.
Yeah, from me. U.S. Steel CEO says he can't imagine Nippon Steel not going through, describes national security review of Nippon Steel as very robust. We trust the process. We respect the process. He says the deal will stand on its merits. It'll go through. And then last night after the close, it won an extension for U.S. review of Nippon Steel. So Either way, like the stock is now perking up. Right when I saw that the stock was up, I was like, oh God, Dennis is going to kill me because I was there yesterday while he was talking about the deal going through and I didn't let
And
you
we've
know.
been talking about this, and we know these conferences move when they speak at these conferences, give presentations, they move price. So we need to know where all of these are, folks, obviously. And we know, can you see US Steel moving here this morning? We talked about this the day the deal got announced and the stock popped up to 50. If you go back to that show, we talked about everything that they've been talking about. Is the company's called US Steel. And I said, if I was long this, I would ring the register as fast as I could because antitrust issues are going to be here simply because of the name. That is what happened. Obviously, the stock has leaked away all of those gains over the course of the last 9 months. When it got under 30, it was a buying opportunity because Cleveland Cliffs said they're still interested, and we knew they were interested in the mid 30s. So anything under 30 is probably a buy. I don't know if I'm coming in here buying today, but I mean, if the deal does go through, the stock's over $50.
My favorite part too is he was talking about it. He was like, this deal with Nippon, or I think it's Nippon Steel. He's like, it will be good for every stakeholder. It'll be good for the shareholders, the employees. He said it'll be good for the country. He said it'll be good for the planet because because Nippon,
pushing, man.
yeah, because Nippon has more I
Good
guess
for the planet.
Nippon has like a very robust, like greenhouse gas emissions. So he's like, if you care about the environment, you should want this deal to go
will
through.
stop global warming.
Yeah, he said it'd be good for the planet and not just the country. And the other thing too, I mean, is because from the political side, they're basically saying national security issues. And then now Japanese officials are coming out and saying national security issues, like we're your friends. Like if we want to take on China, this helps us do it. So like we're running the risk of kind of ticking off some of these people in Japan over again, like an $8 billion company. It just seems like the whole thing is it just reeks of, political optics. And it's like, I almost feel bad for this guy. Cause again, like what they really should have done was change the name, then announce the acquisition.
Yeah. That would have been the better call. If you wanted to get acquired, change to Japanese steel,
yeah.
And then it would have been good to go.
But either way, again, you're seeing the stock pop up. I ultimately, I do think the deal will go through, especially after hearing him talk yesterday. But of course, he was kind of talking up his book. He had reason to. So there's your news on U.S. Steel. So now this decision will probably be pushed until after the presidential election. So like if you're sitting in it, just waiting to see if this deal will go through, I don't know. I mean, it'll probably be. I guess it's only 2 months away now at this point. But either way. U.S. Steel up 4% this morning. Next time, Dennis, I go to cover an executive speaking, I will let you know.
So, and definitely do that. And chat, let us know when you know something is speaking at a conference. Let us know in the chat as well, because again, these lists are hard to come by to get, and there's just a lot. I mean, I think it was Bill that tweeted at me from the transcript, and they had a great list, but there's so many companies on this list. So, I mean, it's just good to know, the major companies or companies that are obviously talking about merging with other companies when they speak. So let us know, chat. Moving on, S&P is leaking a little bit here. We are just choppy. This is Fed day, D-Day, the day we find out if it's 25 or 50, the day we find out if he's dovish or hawkish, the day we find out everything the Fed is thinking. And obviously this decision is going to come here. 2 p.m. We'll know a lot more. Right now, the market just kind of a little bit choppy ahead of it. The question is, where are we afterwards? So chat, are we going 25 or 50? And if they go 25, I think the algo sell it off. If they go 50, I think the algos buy it. But then it's all going to be about the tone. What is he saying? What is he thinking going forward? I mean, that's going to be the major. So once you get the initial algo move, then it's going to go to one, what's in the commentary and the statement, but two, what's the tone like coming from the presser? What's he saying? Does he get caught up in something? So don't just, if we get that initial spike, don't just think we're long and gone. It could be choppy still afterwards too. So I don't think this can be a very easy one to trade. I expect a lot of chop.
Yeah, and I'll just throw it out. I'll just throw my, I guess, prediction out there because I don't mind, if someone comes back and says, "Oh, you were wrong." Okay, like I don't know either way. I think I'm with Crassy here. I think not most likely, because I think the market's kind of pricing in 50. I think the Fed will go 25, but then paired with very dovish commentary regarding more future rate cuts. And then my reason for that is because, there's this idea that if they go 50, it's going to signal worry about the economy, and people are going to think, like, oh, they waited too long, and then, stuff hit the fan, and now they're going 50 to try to fix it. And also, I think there's a side of it where if they go 50, you'll have a lot of people coming out and basically being like, it was a political move. They're trying to prop up the market ahead of the election. I don't think they even want to, deal with that at all. So if they go 25, but then pair it with dovish commentary, that might protect them again from people that are, either scared that they're going 50, that the economy is like all of a sudden going to collapse because they go 50. That's, I guess, kind of my prediction. I wouldn't be surprised if they go 50 because that's what the expectation is now at this point.
I think there's so much to think about here. And I think predicting this Fed outcome is even difficult to know. Like, we always know what they're going to do. Almost always we know, what the move is. We don't even know what the move is. Like, is it 25 or 50? We don't even know that. So obviously, there's lots to chew on here. But I think it's going to be a chop fest. I think you're going to see some wicked spikes, some wicked drops. It's going to feel like you're on a roller coaster here, I believe, right at 2. So I think before, you're going to have a little bit of chop as people and money managers are positioning ahead of it. But I think even afterwards, you're going to get a lot of chop.
Yeah, and I mean, this is one of those things where you could give me the tape beforehand, and I wouldn't really know what the market is going to do. And so so you have the decision that comes out at 2, and the market will obviously be volatile right off that. But then at 2:30 is when Powell will take the podium and start talking, and you'll see some more volatility there. But at this point, if like a month ago we would have gotten 50 out of nowhere, I would have assumed, or not out of nowhere, but like if the odds were essentially flipped and it was more likely that we were going to get 25 and we got 50, I'd be more confident that there'd be a rally off the announcement of 50. But now that the expectation is 50, I don't think just because if they announce 50 at 2 p.m., everything's going to start ripping, because again, now that's the expectation. And so
is there the possibility that this is a sell the news event? Asking the chat this as well, because we look at the IWM and here is your tell. Just like an earnings play, treat it like an earnings play. When you look at this IWM chart, we have had your classic run up into the event. 204.21 5 trading days ago. Now we're 218.93. That's just a quiet 5% run here in 5 days. That's a big move, folks. That's a big move. So we've got to consider that we have actually run up into this event. S&Ps as well, down to 540, up to 563, cooled off a little bit yesterday. Some of your tech stocks, not so much. We know the tech stocks don't care as much about interest rate cuts as obviously some other sectors do. TAN has run up a little bit here. 5 days ago under 38, now over 41. We have had your classic run up ahead of the event. That means the bar is high. So what does that mean? It means that they want the 50. It means they want dovishness from Powell during the presser. The bar is high here, folks. Just consider that. So it's not just a slam dunk the stocks necessarily go higher because of everything that they do today. The bar is fairly high. The IWM chart kind of scares me going into this Fed meeting.
Someone in the chat asked you, I think that's what they should do or what I think they will do. I think they should go 50 because I think they probably should have cut 25 in the last meeting, just because we had already had signs that the labor market is cooling a little bit and that you had no reason to keep rates that high with inflation coming down. I mean, we've talked about it, a few times in the past couple of weeks, but basically, future fund rates of a 1% higher than the running inflation rate is seen as kind of like the level you want to be at, still restrictive, but not too restrictive. And we're well above that. So I think, they could have easily cut 25 basis points last time. I was talking to Thomas Hayes he's at Great Hill Capital. I think he's been on the show before. But he was basically pointing out that what the Bank of Japan does on Friday could be just as important as what the Fed does today. Because basically he was saying that if the Fed only does 25 basis points and the Bank of Japan hikes, then he said we could see some heavy volatility again like we kind of saw with the yen carry trade
The carry
unwind.
trade coming back into play.
Yeah, because
It's an
there's going to
interesting dynamic. When does the Japan? I don't even know when they meet.
Friday, September
Friday.
20th. So then he said, so he put, you know, kind of paints out these different situations. Said if the Fed cuts 25 and Bank of Japan hikes, it creates again this mismatch, and it'll have impacts on the currencies, and we could see some more volatility. And then he said if the Fed cuts 50 and BOJ hikes 25, he said that's okay. If the Fed cuts 25 and the Bank of Japan holds pat, that's okay too. So basically, he's looking at what the Bank of Japan does on Friday as what could
so
have.
many ifs.
I know,
mean, that's what this is. This is a Fed meeting full of ifs. If they go 25, let's just lay it all out. If they go 25 today, the market goes straight down on the number. Now, can it bounce because he says there may be in some dovish tone after that? Maybe. But I mean, so for the market to rally, this is what has to happen. It has to be a 50, and he's got to be dovish. For the market to sell off, he just has to do the 50 and be a little bit like, well, we're going to wait and see, a little bit on the hawkish side, or not, or just not dovish. I mean, there's a lot of scenarios here where the market could actually sell off on this, believe it or not. So, but I think if he goes to 50, I think you get the initial algo spike. I just don't know if that initial algo spike is going to be a fading opportunity. So this is going to be a very interesting event because one, again, we don't know what they're going to do, and we always know what they're going to do. Two is we don't know the tone. We don't know the questions that are going to come out. We don't know the path. You know, think about our T3 guest yesterday. We need to know the path. You know, like we want that dot plot laid out, you know, kind of lay it out for us because we don't know what the Fed's thinking for next year. We know that they're thinking cuts this year, maybe how many? Lots of questions to be answered here. Algos are going to be listening very closely.
I'm with you, Dennis, that I think this easily could be a sell the news event unless, especially considering the IWM, unless they go 50 and then sound super dovish. It'd be hard to imagine the IWM does not go up in that scenario. I'm not going to say it's impossible because we've seen the market do crazy things. But if they go 50 and then they're also dovish, and the IWM dips, I'll tell you what, I'll be a buyer. I'll buy the dip on that because and people, I mean, so, and we'll move on from this because we do have some other things to talk about, but aren't rate cuts signaling something is broken in the economy? So we have seen the labor market cooling down a little bit. But really the big thing is that the Fed is now able to cut rates because inflation has fallen more, not necessarily because there are a lot of cracks in the economy. I mean, we can just look at
this interest rate. This is a fantastic question, and I just want to address it because this interest rate hiking cycle, normally the Fed is raising interest rates to cool the economy. But this was the first one in 30 years where that wasn't the reason. They were raising rates to cool inflation. We haven't had, now we know inflation is there, but the tracked inflation of the BS CPI, we haven't had it, you know, in 30 years really, where we're seeing, you know, this 7, 8, 9%. So the reasoning for the rate hike cycle when it started in 2022 was completely different than the reasoning for all of the other rate hike cycles. I go back until you get back to the 80s when inflation was a serious problem. So this is the reason, maybe the 90s, there was some inflation there too. But I mean, 20 years, we've only raised rates to cool the economy a bit, not worrying about inflation. So completely different reasoning. Now that inflation, by their metrics, has cooled, that's why they're lowering. So we can say, well, they only lower rates when the economy's got problems. So that is not the case here. They are lowering rates because they are taking back the rate hike cycle that they got to cool the inflation. So this was an inflation story, non-economy story. So you can't have your cake and eat it too and say, you know, well, they weren't raising for that, and now they're going to raise because, or they're going to lower because the economy's in trouble. Just not the case. So I think they know the economy is, you know, not, you know, flying, you know, high. But I don't think anybody thinks we're in a recession right now. I don't think anybody thinks that.
I think a lot of people do, Dennis.
Well, it's a recession for half the population always, AB. I mean,
know.
Half the population always struggles to pay the bills. Half the population, the bottom half is always in a recession. They're in a permanent recession. And it's not going to get better with AI, folks. I'm sorry. It's just not going to get better. But they're not, the big spenders of the economy. They're paying the bills, they're getting by. How many people are on food stamps? I mean, they're always there. It's difficult, like this is, capitalist society here. You've got a separation between the wealthy and the wealthy, and the gap has gotten wider over time, and it continues to widen, and probably AI makes it widen even more. But I think when we look back here, the reasoning here is completely different for lowering rates here. I personally don't believe the Fed is lowering rates today because they think the economy is in trouble. I think they're lowering rates simply because they have inflation in check. Now, is the economy in trouble is a completely different question. Are we teetering? We know big ticket items aren't selling as well. We know people are still finding money to do certain things. Some pockets of the economy have not done well. Certain companies definitely need interest rate cuts. We talked about these companies, the solar companies, the small caps. They need cuts. So some of that may be out of necessity, but overall, the Fed is taking back today just what they brought up because inflation, by their metrics, is in check.
Just real quick. I mean, so this is the unemployment rate. And I'm just on Google here. And I mean, so you can see right here in the last few months, this slight uptick from, I mean, I think it's called a little bit more than slight, from 3.4% up to 4.2. So we know the labor market has been cooling. But if you look at this graph historically, where we're at now at 4.2%, okay, go back to, May 2017, June 2017, it was at the same 4.3%. We weren't in a recession in July 2017. I mean, but the difference is the trend there is it's going down. Here it's starting to tick back up. But either way, my point is that the unemployment rate right now, despite the recent uptick, remains at normal historical or relatively low historical levels.
Yes.
Now we can go to the GDP now from the Atlanta Fed, which updates daily, and it's basically just the GDP projections. The blue chip consensus here, and this is for Q3 2024, the current quarter we're in. The blue chip consensus is right below 2%. Atlanta Fed GDP now says, no, it's really closer to 3%. If you have GDP above 2% in a quarter and unemployment at relatively low or historically low levels,
all the data says we are not in a recession, folks.
And we're getting rate cuts. So the fact that people and again, I understand why some people are worried that 50 basis points would signal an economy weakening, but I just don't think that's really the case. And to your point, Dennis, I think you're spot on that the Fed is not cutting because they're really worried about the labor market. They're cutting because now running inflation rate is below 3%. So there's no reason to have
taken back what they did because they've got basically, they're getting the levels back to where they want to get them.
And
so, but we're not saying AB, and then they're going to chat's getting on us here. We're not saying the economy can't fall off a cliff here. We're not saying nobody's got a crystal ball. Nobody knows anything. Remember how I always said nobody knows. We don't know where we are 6 months or a year from now. We do know if rates stay elevated for a prolonged period of time, you start to see cracks. Do we see cracks? Yeah, we see cracks. There are cracks. But the data itself, you're just going to data dependent, doesn't really say the economy is in a recession. Is it slowing? Maybe. There's some data to dictate, it's for certain pockets that are saying the consumer's getting stretched. We can see credit card debt, elevated. We can see, the consumer's cash savings have gone down. So predicting that, probably if the rates stay elevated and continue to stay elevated or go even higher, the economy will go into recession. So there's a little bit of preventative maintenance here and saying, well, the economy is not flying high. It doesn't look like inflation by their metrics is returning anytime soon. So why not go 50? I mean, that might be the conversation in the room.
Yeah, I mean, it's just an interesting scenario because people are comparing it. Oh, the last few times we got 50 basis point cuts, but this is a completely different scenario. I mean, I think it'll be, and the other part of it too, Dennis, is that the stock market does not equal the economy. So even if the economy remains strong, you could still see a sell-off in the stock market or vice versa. You could see the economy weakening and the market ripping and people are like, what's going on? So there's always going to be a slight disconnect there. Let's get into a couple other headlines before we bring on our guest of the day. We have one earnings stock, Dennis. What was
GIS, General Mills reported earnings. Let's go see if the economy's in a recession from General Mills. Go, AB.
From cereal?
Yeah, maybe cereal. People aren't buying cereal. The economy's really in trouble. Or people aren't buying cereal because they're going out. They have so much money. We don't need cereal. there's your black and white scenario. There you go.
General Mills non-GAAP EPS of $1.07, beat by 1 cent. Revenue of $4.85 billion, beat by 50 million. Reaffirms 2025 outlook. So yeah, I mean, like, I don't know how much we can. I mean, cereal company, boring. Barely beat EPS, boring. Barely beat revenue, boring. Up, down 2%. So all in all, I don't know, kind of boring earnings reaction and report here. I don't know if you have other. Were you trading this into the report?
Boring. And this is our only earnings stock of the day, so boring. So we won't cover it too long here. Our margin's going to be squeezed here a little bit, maybe in there, obviously, you know, but again, cereal is pretty much, you know, you can kind of pass these costs on to consumers, which is why this stock's held on very well compared to like other stocks. General Mills, 75. It's kind of run up into the report to a certain extent. We were 62 back in July, so we've just been going up. So does it cool off here? Does it find buyers down at 72? Probably. That's where your bottom was back in September, just 4 days ago, 72.07. So I think your first spot where buyers might emerge is there. Am I getting all excited to go buy General Mills? Nah. What I will say, you know, as a rising rate environment, General Mills is a lot more attractive. Or a lot less attractive. When rates start to actually go down, General Mills becomes more attractive. So I think the recent run up in all your consumer staples and all your utilities is the fact that interest rates are starting to go down. Long-term rates going down, consumer staples, dividends, because these are yield plays, are more attractive. All those stocks, those preferred stocks that I sold out of my long-term portfolio in 2022, because I was like, well, if I can get 5.5% or 6% in a GIC risk-free, why am I in a preferred stock at 6% and taking on market risk? Not that there's a lot of market risk, but if you go really into a crisis, we've seen preferred stocks get beat up. There's a play now on dips where all these stocks are buys because rates are going back down. So that's why preferred stocks too have been coming back up. And that's what I compare General Mills to. It's like bond, preferred stock, all that stuff is attractive here and probably remains attractive because it's not going to be a one and done for the Fed. I'm going to predict that right now.
Oh, for cuts?
Yeah.
Oh, no, not a
we know
chance.
that.
I mean,
it's an obvious guy says. We're not one and done here. So, I mean, if you're sitting here and saying, I've got to sell the TLT right now because this is, you know, we're rates are going to end up starting to go back higher, I don't think anybody's on that side of the trade. It would really screw people up if the TLT started tanking because I don't think anybody's predicting that. But I think I look here and think, is this TLT rally over? The reason we're talking TLT because General Mills, put those two charts on top of each other. General Mills will trade with the TLT more than it will trade with SPY because it is like a bond. They're in there for the dividend. There isn't much growth. It's just consistency. That's what they're in there for.
All right, let's go ahead and bring our guest on the day. I've seen him waiting back here for a few minutes, Mr. Jim Tassoni. Without further ado, let's give Jim our special pre-market prep welcome and see what he's got going on. All right, Jim, welcome back to pre-market prep. How are you doing this morning?
Good, guys. How are you this morning?
We're ready for this announcement. And honestly, I was being kind of dumb going into today, and I was so used to the like 8:30, you know, decision or CPI data that I was like, for some reason, I felt like it was supposed to come this morning. Then I realized when I got in the office, I was like, wait a second, this isn't until 2 p.m. Now I got to wait all day for this. So I was all amped up thinking we were going to have you on after knowing what the Fed was going to do. Obviously, that's not the case. But what do you think the Fed is going to do?
Well, I actually wish that was the case because then I could sound a lot smarter because I could tell you what I thought was going to happen and align it perfectly with what did happen as we see a lot of the time. And then I would have sounded super smart. But before we get started, I will, on the General Mills stuff, I will say in the Tassoni household, we are super bullish cereal. I have an 8-year-old and a 5-year-old, and the Reese's Puffs, the Captain Crunch.
All good ones.
Don't yell at me for feeding my kids poison, but when you're trying to get them out the door early in the morning, we are very, very bullish cereal here.
I'm with you. I'm with you, Jim. We try to get these kids out the door in whatever way we can. If it takes a little bit of cereal to get them out the door, so be it.
It's not. I mean, if you go the Captain Crunch, if you get the one with the berries in it, that's healthy, right?
That's
Yeah.
fruit. Yeah,
Fruit.
they're getting your fruit
Yeah.
then.
You get a full serving of fruit in every bowl of Captain Crunch berries. That's a good
Exactly.
deal. All right, well, Jim, right now, I mean, the question is 25 or 50, and I would argue the bigger question is the reaction to either 25 or 50. So, I mean, give us the case for either way right now. If they go 50, what do you think the reaction is going to be? If they go 25, what do you think the reaction is going to be? How are you positioning ahead of this?
Absolutely. So I've gone ahead and I'm going to share some slides here,
Yep.
and hopefully you can see those. And we'll talk this through a little bit. I may be a little contrarian. I've heard some of the comments by you and Dennis, and I think I may have some points that might be a little bit contrarian to what some people are thinking. I'm not saying it's necessarily what's going to happen, but I think it's really important to look on both sides. So the first thing I will go ahead and show you is this slide. I showed it the last time I was on, and I caught so much you know what for this slide. And a lot of people are saying exactly what you guys are saying. Well, this is looking short term. It's only the last few rate cuts. It's not the same type of economy or the same type of market.
Yes.
And so what I did was I went ahead and pulled back a little bit, because I'm the first one that can accept constructive criticism and say, okay, that could be a fair and valid point. So let's look at what's gone on as we pull back, maybe going back 50 years, back into the early 1970s. And so here are S&P 500 returns 3 months, 6 months, and 12 months after a rate hike, or excuse me, a rate cut. And Dennis, you pointed out that this may be more similar to that early 80s time frame where we had inflation spike, and as inflation started to cool, that allowed the Fed to start cutting rates. So you can see sort of those early 80s rate cuts, 81, 82, 84, not particularly great over the next 3 months. But in 2 of the 3 scenarios, we had pretty strong markets 6 and 12 months out. So that augurs well for the markets in the longer term, but maybe we want to be a little bit cautious in the shorter term, especially heading into the election, end of the year. We've had a lot of run up in the overall broad indices. Just something to think about. Now I'll get to the part where everybody wants to start screaming at me that there's nothing similar to 2007 and 2024. I love to put this bear porn on the screen just to start those conversations. This looks at the blue line is where we were when the Fed started cutting rates on the S&P 500 in 07. And now we see where the markets are when the Fed is all but for sure going to start cutting rates today. It's kind of eerie 17 years apart that it's the same day. But you see what happened to the S&P 500 going forward. Now, I've heard Aaron, I've heard you argue, and I can agree with it to an extent that the markets are totally different today than they were in 07.
Yes.
But the one thing I will say is, are they? And just take a second to actually look at the data. I'm not calling for an 07, 08, 09 style crash, but look at this data. When we say,
oh, wait, Jim, I think, do you need to go to the next slide? Are we still looking at this one?
Are you looking at the next one now?
I don't know. Some people in the chat were saying, I don't know. But
you're on the should we hope for 50 basis points? Did we? I think you were still talking about that one.
Yeah, just continue. I'm sorry.
No problem. So are we on the slide that shows it's called deja vu all over again?
No, they're right. Now you got it on the next slide.
We're still seeing the first one. But wait, Jim, before you move on, and I like having these, good conversations where we might have some disagreements. If you go back to the first one real quick, that we were on, the one from Charlie Billow that shows the last times we got 50 basis points. That one doesn't have the very last time we got 50 basis points, which was right before the COVID in March 2020, and the return was great after that. So, like, if this chart showed that too, then we've had kind of mixed results after 50 basis points the last couple times.
100%, and that's why I like to say you have to take these things with a grain of salt, and you have to be able to interpret not only what the data shows, but also the market's reaction to the data, because the market doesn't always react the same way to the same data at different times. And so that's why I'm a big guy who looks at the market's reaction. It's much more important. We love to have these conversations about forecasts and what may or may not happen, but more important to all of us when we're trading and trying to make money is to establish areas of value, look how the market reacts when it gets to those areas of value, or the stock that we're looking at reacts. And that's how I trade. I like to look at identifying areas. How does it react? How can I limit my risk and maximize my reward? So I'm with you. So now, Aaron, can you see the deja vu all over
Yes,
again?
we do.
Yeah,
Yes.
Before we do this one, can we see the other two slides that we because they were asking about, now the chat's asking about the blue line, and I wanted
Yeah, we missed these ones.
Oh, you missed these ones.
Yeah,
I'll
it never rotated through.
Yeah, for
You just
whatever
had the first
reason,
one.
I went into slideshow and the slideshow didn't go through.
It probably started in a new window and you were sharing this window and it stayed there. So what you were looking at, it was changing, but it didn't hear. But either way, we're on the right. We're on the right side.
Show the slideshow window.
We'll work through my technical naivete, and thank you, chat, for pointing that out and helping us on that. So
yeah, because you're actually seeing the entire PowerPoint like you're presenting it, not seeing the actual like slide blown up like a slideshow would. So you'd have to show, like, you could start the slideshow and then show the other screen.
Yeah, yeah, there you go.
He's fixing that now. Chat, we love the chat. They're all over everything.
But it's not going to let me because I can't switch to the other window when I'm.
Okay, that's fine. Just bring it back up and just manually go through it. It'll be okay.
Okay.
We got time. We brought you on. We brought you on early for a reason. We knew something was gonna.
Yeah, exactly. When you have. All right. So here we go. All right. So I apologize being able to see the entire.
That's fine.
The entire slideshow, but we'll still point out the facts here, which are more important. My wife always says that my analytical skills are way better than my beauty. So I guess we'll go the same here. The facts are more important than the prettiness of the presentation. But Dennis, you can see here, to your point, and this is what I was talking about before. If we look at the 81, 82, 84 time frame, which may be more of a corollary to where we're at now, and when the Fed started cutting rates, you can see that the first 3 months out were not great in any of the situations, but 2 of the 3 times we had really strong returns 6 months and 12 months out from that initial rate cut. So I think, again, it may be worthwhile having some caution as we head into this. You guys talked about a potential sell the news. We don't know if that's going to happen, but at least look at this as some type of corollary to what went on in the past and what we may be looking for over the next 3, 6, 12 months. Now to go into that length of rate cuts.
That chart scares the hell out of me.
And this is what I was talking about.
Now I'm turning around selling all my stocks.
This is the bear porn that we all love, right?
All right, that's fun.
This is 07 when we came to the first rate cut. The blue is when the rate cut started. The red is the length of the rate cut and what happened to the S&P 500 subsequently. 2024, it's kind of eerie, but that's the length of the rate cuts, the current probabilities, where the market's at right now. I'm not saying this is going to happen. And again, we had that discussion, and I mentioned how Aaron said this time was a little bit different. And that's why I just want to point this out. And I'm not, again, calling for an 07 style crash. I'm just saying, with the market run up we've had, it always pays me to be a little bit more cautious and to at least be aware of what's going on. And let's look at these metrics a little bit. This is where we were at when we first cut rates on September 18th in 07 versus where we're at now. You can see unemployment rate pretty similar, 4.7 versus 4.2. Inflation rate, 2.5 on both. Housing starts very
You're
similar.
scaring me. I read them all. They're all the same. It's
Reading
the same
economics,
thing.
U.S. existing homes. So
We're dead.
so all I'm saying is, when we call for the economy was totally different in September of 07 than it is today. The facts don't necessarily bear that out I understand we're in a totally different world than we were 17 years ago. The economy looks different, it feels different. The leading industries and sectors are different, but it's just something to pay attention to.
Better hope that regional banking crisis doesn't come back right now. That's what I'm saying. We don't need regional banks failing right now, because then everybody's going to draw these similarities.
Absolutely. So here's a slide, and this gets a little bit wonky, so I'll walk through a little bit slowly. But this is a totally contrarian thought, but something I've been doing research on, and I think something that we should at least keep in the back of our minds. So if you see currently, we have a Fed funds rate between 5.25% and 5.5%, and we have a 10-year Treasury yield, when I put this slide together, that was at 3.65. Now, over the next 12 months, right now we're implying about 250 basis points of cuts. So some pretty significant cuts going on over the next 12 months. If we get those cuts, that would bring the Fed funds rate down to 2.75% to 3%. Now, historically, if this market uninverts and we go back to the historical, and I went back to all the way to 1962 to look at this, so more than 60 years worth of data. Historically, we've had about a 1.5% to 2% spread between Fed funds and treasuries. So if we get down to 2.75 to 3, the curve uninverts and we get to that 1.5% to 2%, that would imply a 10-year yield of 4.25% to 5%, which is higher than where we're at right now. So is there a possibility, with the market being where it's at right now, that we could have significant interest rate cuts in the Fed funds rate and the 10-year Treasury yield could actually go higher by 15 to 25%? I think it's something to pay attention to.
Wow.
And when we talk about potential, and I'll go on to the next slide, looking at both the TLT first and then also the GLD, if this is a possibility and if we see something like that, everybody is on the wrong side of the trades for the TLT and for the GLD. And so watch these areas. If all of a sudden we see ourselves sliding and closing back below 100, and especially in my opinion, under that 97.42 level that we see, that's got a good wall of support down there, we could easily see a slide down to 93.75 to 94.75. Again, not a prediction, not a recommendation. It just, this could really catch some people off guard. Same thing with GLD. We see the run that we've had. We see the overall strength in the market. We're bumping up on a resistance area in that 239.25, 239.30 area. I think watch how it reacts if we get a rip off the news later today. If we can't close above that level, we could potentially see back down to 231 and then major support in the 220, 222 area. But that's a significant trade if it ends up playing out. And again, I don't predict this over the next day or two. This is a longer term, 3, 6, 12-month trade that could play out. Couple other sectors real quick to look at. What is interest rate sensitive? Obviously the REITs. And so how do we potentially want to play this? I'm looking at Welltower and Ventas for 2 reasons. One, you can see the astronomical run that a stock like this has had over the past few months. It's in very overbought territory right now. And I also think heading into election season, there's always a lot of rhetoric, and it's the one thing that both sides can agree on when it comes to healthcare, providing more subsidies for seniors. If something ended up getting passed, if something got floated, that could hurt these companies' margins, as they're the leading providers of senior housing and senior assisted living facilities. Watch for different things coming out on the fundamental news side of that, along with these stocks both being in very overbought territory, and that potential for yields actually going higher, which is not a prediction, but a potential. I think you may want to look at these stocks, at least if you're in them, potentially taking some profit, tightening up your stocks. If you're not, you could look for areas to short. I've highlighted some support and resistance areas in these charts. If you want to hedge the position, I know, Dennis, you're a big market neutral trader. Look at, I mentioned Prologis last week, Simon Property Group. These stocks are in areas of the market that I think have a lot more value. There could be bargains to be had in the warehouse and especially in the office sectors with what's gone on. I think that these companies can pick up some properties on the cheap, and I think that might be a good place. I would rather be in those stocks versus a Welltower and a Ventas.
That's a lot of information to take in there, Jim. And
Yeah.
I think it's good to, I really like having, kind of diverging opinions and being able to have these conversations with, because now, maybe, there are some things that we could be a little bit, I don't want to say worried about, but a little, I guess, just cognizant of going into these rate cuts, that there are some maybe parallels between past times we're cutting rates. So basically you're
Too many parallels. I'm like shocked at the parallels, at least in the data. And I mean, the path to which we got here is, I don't know the path, but it's maybe the reasoning is different here, but the parallels are scary. And and what about, and the chat's bringing this up, but what about valuation here? Jim, we'll ask you about this as well, because in 2007 valuations, were starting to get stretched. We had been on a 4 or 5 year run back from the lows of the tech bubble burst. They weren't crazy. What about valuation here now, like comparatively to 2007, 2008? Because chat's saying we're 21 times. I don't know if that's up. That's pretty close to probably where we are on the S&P. How's valuation look from a comparison standpoint?
Yeah, I think obviously there's, from a valuation standpoint, there's pockets of the market that are definitely stretched from a valuation standpoint. I think we're probably in a similar, and I don't have the exact data on valuations in 07 versus 24, so I don't want to speak specifically to it, but I will say that we are selling from a valuation standpoint on the high end of historical valuations. We definitely aren't undervalued. This isn't a situation where the overall market's selling at a 12 or 13 PE. I mean, you look at certain metrics like, cyclically adjusted PE ratios, the CAPE ratios. We're in the highest decile in the history of those ratings for as far as the US stock market goes. So valuations are definitely on the higher end, which again might bode some caution, but I've always been, or I will say, I've never been rewarded from trying to buy the overall market or sell or short the overall market based on valuations. Because in my 20 plus year career, valuations can always get more expensive and they can always get cheaper. So
all right, Jim, do you have any other slides we didn't get to? We are running out of time here.
No,
so
I think we can leave it there. I think, like I said, the one thing, and then I'll leave it back to you guys, is just to have this slide that I have up right here in the back of your mind, because this is the one that I'm really thinking about. Because if this comes to fruition and we see them lower rates and the TLT rates, the 10-year rates continue to creep higher, this is catching everyone on the wrong side of the boat.
Everyone.
So
if the TLT goes lower, the world is on the wrong side. Bonds go lower in this environment, like long-term bonds, it will like catch everyone on the wrong side. Like this is what I said 15 minutes before you came on. I'm like, I'm trying to figure out the scenario for where the TLT goes down, and it's not obvious, and everybody is on that same side of the trade, including myself, because I've been saying I'm starting to, look at, obviously, in the last couple of months here, putting preferred stocks back in because they yields, were comparative with cash. But, going forward here, that's not going to be the case. If the low end's going down, you're going to want to, but if that spread widens to what you were saying, there's a scenario here where we could get the low end going down, but the high end going up, and that spread widening, which would catch everybody.
Exactly. So just something to be prepared for.
All right. Well, Jim Tassoni again from Armor Wealth. Always great to have you on. Some great, we've got all the viewpoints now covered on PreMarket Prep this morning. So no matter what happens, we can say, see, you could have watched our episode and we would have been right. So Jim, enjoy the rest of your Wednesday. Of course, the decision day, big day here for the market. We'll be talking to you next week.
Thanks, guys. Good luck out there.
Appreciate it.
Thanks, Jim.
All right. That was a lot of info there from Jim.
Some piles on the info. That's packed in. A lot of info there in the last 15 minutes. Lots to chew on. And I mean, just thinking about, the other scenarios where that gap, we go back to normalization where the long end is here and the short end is here. Like there's a lot to think about there.
No doubt about it. I mean, I'm still, Jim maybe a little bit more cautious about the rate cuts, but I still think, that I don't know. I still think 50. The only reason I say that the Fed should do 50 today is because I think they should have gone 25 in the last one because we had already started to see signs.
And I think that's what they're thinking. I think they're going to go 50 for that reason. I think we're going, so we're just going to have the guesses out there. Chat, you can put your guesses out there once. I'm with you, AB. I think they're going 50 today. I think they're going 50. This is and again, we don't have a crystal ball. Could be dead wrong. I think they're going 50. I think the algos are ripping it on the 50. I think the initial spike is higher. And then I think it's going to be like, is there follow through though? And then it's going to be like the humans are going to be waiting for the conference call. And the algo's like, ooh, we just bought it up here. Where is the rest of the buyers? And I don't think there's a lot of human follow through. And I think it could start to leak into the conference. And then it's going to depend on obviously what comes out of his mouth. The questions, question answer, Q&A, we always get a lot. We get some spikes off that too. So I think there's going to be a 50, an initial spike, and then I think a leak. And then I think it's going to depend on the tone on what he's saying in the presser.
And I'll go, the opposite is if they go 25, then I think off the rip at 2 p.m., you'll see maybe a little bit of a sell-off. And then if they do go 25, I think they'll come out, or Powell will come out at 2:30 and sound very, dovish. And then the market will have a little bit of a rebound. But again, we don't know what's going to happen. These are just predictions, and I don't mind throwing mine out there and being wrong.
That's what it's all about.
Yeah.
We don't hedge ourselves on pre-market prep. We just throw it out there. We're not one of these, where if it goes up, then they're going higher. If it goes down, then they're going lower, and everybody wants to hedge themselves, so they don't want to be wrong. I'm wrong all the time. I'm okay being wrong. I adjust when I'm wrong. That's what you do.
Well, all right, going back to Jim's points there, Dennis, real quick, because I wasn't I wasn't trading or investing in 2007. But I assume for the most part that there were probably a lot of people that felt like the economy was strong before the cracks started to really form and show. And do you feel any parallels between now and 2007 or
none?
Yeah.
I feel none. And you kind of knew, it really wasn't that way. We remember the famous Jim Cramer rant, when he was ranting about the Fed and you see it advertised, they know nothing. They know nothing. Go out and talk to people. Because we all kind of knew that there were so many cracks happening there, and they just absolutely refused to lower rates. And they needed to. They were late doing it then too. So there is a parallel in that way, I guess. But it felt like we were in trouble. You started seeing some of these investment bank stocks that were falling hard, but there were still other stocks holding up. But Lehman Brothers was cut in half. They still hadn't cut rates. Bear Stearns. And then obviously, it just all fell apart. And we know the financial crisis where people were all concerned, were their banks going to be there? And Lehman, they let go under. Bear Stearns got bought out for $2, closed the day at 30, bought out for $2. I don't see anything like that. The only thing that would draw comparisons, the most comparative was when the regional banks started to go down. That's when I felt like, oh my gosh, if you start seeing all these regionals fail. But we know we never lost any big ones. There was 2 or 3, obviously, we lost in there. I mean, if the regional banking crisis started here again, then that would be really scary, because that would be the comparison.
Well,
but I don't feel anything like I did in 2007.
Yeah, and to your point, Dennis, I mean, Jim brought up the fact that it came on the same exact day, September 18th, 2007. So I have Goldman's chart up, because obviously we can't look at, Lehman Brothers or Bear Stearns chart, but look at Goldman's chart. This was in June 2007. It went from 230 down to 165 before those rate cuts even got there. So going into those rate cuts, you had
the banks were collapsing.
You had this huge drawdown of the banks. We don't have that right now. And I mean, to your point about the regional banks, the whole problem with these regional banks that we ran into was because of the interest rates were higher. So I don't think cutting is going to bring back.
Should help.
Yeah, it should help. Also, I mean, it is time, but I will just say real quick. They
want to talk Lunar too.
Oh my God, we would never talk.
Do we have 2 minutes to go into Lunar?
Yeah, I know we can go.
They want to do it, so we'll go overtime for you in Lunar. It is a big headline. It is your biggest mover of the day, Intuitive Machines. I do follow the story too, and I was sitting there and watching my pro last night when this headline broke. So give us the headline, AB, and I'll take you through. I made some trades on this.
All right. Well, the news came after
AB,
the close yesterday. No. You went out for a second, but I think you're back now. Intuitive Machines got a NASA reward for over $4 billion, or a maximum potential value of $4 billion. So again, this hit Benzinga Pro at 435. So Intuitive Machines says NASA awarded near space contract for communication and navigation services. Contract has a maximum potential value of $4.8 billion. So you're talking about a potential value of nearly $5 billion for a company that's at a market cap of $340 million. So obviously,
it's a huge deal.
Yeah.
And when I saw that headline, the NASA thing, and it hit, the algos are so fast. I brought it up. I was like, oh my gosh, I got to my screen and I brought it up, and the algos already had it. And it was 6 offer and 20,000 shares at 6. I went to lift the 6. I got nothing. Shut out. I was like, you kidding me? With 20,000 shares there sitting on the offer. And then it was up at like 7, like really fast. Pulled back down to the 656 area. I was able to buy some at 670. So, I mean, the algos are so quick now. Back in the day, 15 years ago, I would have just killed it on that headline. But the algos are so fast. They take all, they pick off everything that's just sitting out there in the book all the way up to like $7 almost. Although, like I said, they only picked off the first like 50 cents. And then they paused at 6, but then somebody else came in, or the algos came in and bought the 6 as well. Maybe the slow algos there. I thought I would have got the 6, and I didn't. Went up to 720, pulled back to 660, 670, and that's when I was like, I think this is the buy. I did buy some stock at 670. I flipped out last night. I thought it was going to go higher. I kept thinking it was going to go higher, but then it was just sitting there, just hanging out at 735 for like 2 hours. And I'm like, okay, I'm done. And then the last hour it ran up to 9. So I did sell out too soon, but this is a big deal. I don't think it just gives it right back. The reasoning is you got a $339 million company talking about $4.9 billion revenue. This $4.8 billion contract over 10 years. Yes. And its potential, they've got to hit the targets. They've got to be able to do the stuff. But I mean, this is a big deal for this company. So I don't think this just, all of a sudden goes back to 6 and is a nothing burger. I actually think this is a something burger headline for this. So I don't know if I'm just necessarily fading this move.
I agree. And I mean, again, the deal with the maximum potential value of $4.8 billion doesn't necessarily means that like, Intuitive Machines is going to get $4.8 billion back from this deal. But if they succeed on this deal, then hypothetically that should lead to more deals. And so again, some big implications here for Lunar. Stock up 55% this morning. It is your big gainer of the day. And smaller company, I mean, rate cuts should help Lunar as well. So we shall see there. But all right,
my only rate cuts matter nothing to Lunar right now. It doesn't hurt them, but it's all about this. Can this see? It's up 16 million. It's going to be your big stock of the day trading. Watch the opening print. You don't want to see like this thing open and then just and all the profit takers come in. Sometimes you get that initial dip because people are really excited to take the money and run. People who were in this before that news. There was lots of people who talked about this in social media. So there'd be some people who are looking to take profits. But I think an initial dip, if this thing like opens like 840 and dips down like 750, I think you find buyers. So I'm actually looking at this as a buy the dip opportunity, believe it or not, if you get a dip. So I do think this headline's big for this company.
There you have it. All right, well, we went a little bit over today. Again, big day, 2 p.m. We'll get that decision. 2:30, we'll get Powell speaking. Tomorrow morning, we'll discuss the reaction. Tomorrow morning, we'll have Tim Seymour on. So that's
Nice.
a good guest to have after today. So, guys, stay green out there. It should be an interesting day. We will see you guys tomorrow, 8 a.m. We do have live trading starting up right after this to walk you through the open. So stay tuned. And with that, we'll see you guys tomorrow morning.